This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Thursday, July 2, 2026, and this is the After Hours session. Now, let's get into it. The Fear and Greed Index is sitting at 14 out of 100. That is not just cautious, that is a state of panic. We are seeing a massive rotation out of risk assets and into safe havens, with gold leading the charge. But there is a strange dissonance in the data. While currency traders are fleeing in terror, the VIX is barely twitching. Let's look at what the numbers are telling us right now. Before we dive into the charts, let's look at the calendar. We are closing out a shortened holiday week here in the US. The biggest headline driver this week was the non-farm payrolls miss, which triggered today's safe haven rush. Looking ahead, the Reserve Bank of Australia makes its rate decision on Tuesday, July 7th, which will be critical for Aussie crosses. Then, on Wednesday, we get the RBNZ rate decision. Those are your two focal points for midweek volatility. So, what is happening in the market right now? According to our director's brief, we are in a fearful regime. Gold is up nearly 1% to 4,072.5. The dollar is strengthening against the yen and franc, but it's hitting walls. Dollar-yen is down 9 basis points to 162.403. And crucially, the headlines are pointing to geopolitical friction, specifically regarding Israel and Iran and central bank confusion, with Lagarde defending a June rate hike while U.S. data misses. Pulse, you own the macro picture. Why is the market so scared when the VIX is essentially asleep? It's because the fear is being filtered through the lens of central bank conflict. We have the Fed funds rate stuck at 3.63%, yet CPI is still running hot at 4.17%. You have a yield curve that is flattening out. The 10-year minus 2-year spread is just 0.35 percentage points. That tells me growth expectations are crumbling. At the same time, Lagarde is publicly defending the ECB's June rate hike. So you have global central banks refusing to pivot dovishly, even as the U.S. economy shows cracks with that non-farm payrolls miss. Investors aren't just scared of recession, they're scared of a policy mismatch. They don't know if the Fed will cut to save jobs or hold rates to kill inflation. That ambiguity is what drove the fear and greed score down to 14.
And that brings me to the elephant in the room. The VIX. It's at 16.45. It's down 1.2 points. Grid, you're looking at chart patterns in dollar, yen, and gold. How can the FX desk be in a freefall with a fear score of 14, while the equity volatility index is practically dormant?
That is the exact question. In dollar-yen, we are sitting at 162.403. That is 91 basis points below the 24-hour high, but it is still razor-thin distance from the 5-day high of 162.8395. The chart shows a classic exhaustion pattern. We tested that 162.8395 high yesterday and the sellers stepped in immediately. Now, we are consolidating between that high and yesterday's low of 162.2985. It's a tight channel. On gold is at 4,072.5. It's holding firmly above today's open of 4,035.5, but it's struggling to touch that 5-day high of 4,116.9. The buyers are present, but they are hesitant to chase. It feels like a pause, not a collapse.
I'm going to challenge Grid on that pause language. In dollar-yen, this isn't a consolidation, it's a liquidity void. Look at the COT data. Leveraged funds have a net short position of negative 97,092 contracts. That is a massive expansion of negative 98,892 contracts week over week. The market is structurally fragile. There is no organic buying power left to sustain a breakout above 162.8395. If price tries to go higher, it doesn't find buyers, it finds liquidations. That's why I'm seeing this sharp pullback to 162.403. The marginal buyer is gone.
CIPHER, you're talking about the mechanics of the short, but Pulse, you mentioned the macro trap. If the yield curve is flat and inflation is sticky, why are we seeing such a split in the safe haven bid? Gold is up 0.92%, yet dollar Swiss is down 0.8% and dollar yen is down 0.9%. The safe haven isn't uniform.
Exactly, Apex. That fragmentation is the key signal. You think everyone is buying dollar, but they aren't. The data shows dollar Swiss weakness and dollar yen weakness. The flight to safety is bifurcated. Capital is flowing into gold and into specific currency pockets, but it's avoiding the broad basket. We saw UBS/oil price forecasts sharply today, cutting Q3 forecasts by $25. That energy volatility is adding to the noise. Plus, you have that headline about U.S. officials believing Israel might plot against Iranian negotiators. That's not just background noise. That is a direct input into the risk premium for energy and, by extension, the currencies of oil exporters. Let's dig deeper into that headline. UBS/oil forecasts, and there is tension in the Middle East. CIPHER, how is that affecting flows beyond just the general fear?
It's causing a selective rotation. Look at the DXY versus the trade-weighted dollar. Leveraged funds are adding to DXY longs, positive 4,438 net, but the trade-weighted dollar index has actually weakened week over week. That means the strength is concentrated in specific pairs, not the whole basket. Simultaneously, they are dumping Swiss franc and Canadian dollar. They are running from commodity-linked currencies. But look at Aussie. Aussie dollar is at 0.68942, down 6 basis points. Yet leveraged funds are heavily long Aussie with a positive 39,111 net position. That is a divergence. They are holding the Aussie long while the price is retreating. That looks like distribution. They are accumulating at the top, which usually precedes a reversal or a period of stagnation where the price can't lift off.
And that distribution signal is visible in the cross. Look at Aussie yen, it's at 111.9625. With the yen short being so crowded, any bounce in Aussie against the yen gets squeezed quickly. But in Aussie dollar, the technical structure is messy. The 5-day high was 0.693, we are well below that. The retracement cipher mentioned is real. The bulls tried to defend the 0.68653 low earlier this week, but the upside is being eaten away. It's not a crash yet, but the upward momentum has stalled.
Stalled is putting it mildly. This is a ticking time bomb. You have a fear and greed score of 14. You have a VIX of 16.45. The gap between those two numbers is where the violence happens. When the equity market finally decides to wake up, that VIX is going to explode. And when it does, the crowded yen short, negative 97,092 contracts, will be crushed. I am watching the VIX range. It has been stuck between 16.27 and 20.72 for 5 days. If it breaks above 20.72, we are looking at a rapid unwinding of those yen shorts. The quiet in dollar yen is not stability. It's the eye of the storm.
So SPECTER sees a volatility explosion coming from the VIX/FX disconnect, and CIPHER sees a mechanical squeeze waiting to happen in yen. But what about the pound? Cable is up 8 basis points to 1.329. Lagarde defended the rate hike, but the Bank of England is watching financial conditions closely. Mann mentioned loosening conditions would influence her vote. Where is the pound standing?
Cable is at 1.329. It is hovering right at the 5-day high of 1.3295. It's touching the ceiling. The 5-day range is 1.3191 to 1.3295. It is trying to break out, but it lacks volume. Compare that to euro dollar. Euro dollar is at 1.1385, up 7 basis points. It is trapped in a very tight 53 pip band between 1.13618 and 1.14142. Both European majors are choppy. The strength in sterling seems more tied to the lag effect of the ECB news than fresh momentum. It's holding, but it's not leading the charge.
And that's the problem. Lagarde is defending the hike, but the broader macro data is softening. The UK labour market is cooling. The pound is riding on the coattails of a stronger US dollar failing to dominate, rather than its own intrinsic strength. If the US non-farm payrolls miss continues to weigh on the dollar, the pound might get a lift, but don't mistake correlation for causation here. Let's look at the Asian session dynamics. USD/NOK is at 9.9107. USD is at 1.2947. These are often proxies for risk appetite. With the fear index at 14, are we seeing carry trades getting dismantled?
Absolutely. Look at the Kiwi. Kiwi dollar is at 0.56769. It's a low-volume pair, but the positioning is telling. We saw the RC retracement. The Kiwi is following suit. The carry trade is being reduced. Investors are taking profits on the high-yielding currencies because the fearful regime makes borrowing costs feel riskier. You see this in GBP/NZD at 2.341 and USD at 2.0055. The crosses are weak. The base currency strength isn't coming from the Kiwi or the RC. It's coming from the safe haven bid in gold and the defensive posturing in the dollar/JCP pairs.
Which brings me back to gold. Gold at 4,072.5. Everyone loves to call gold a safe haven, but look at the volume context. It's up less than 1%. In a true panic, gold gaps up. Here it's creeping. That suggests caution, not capitulation. But SPECTER, I need you to hit me with the risk. What is the one thing that could break this calm? The Bank of Japan intervention whisper. You have a net short position of negative 97,092 contracts. The market is priced for a weaker yen, but the Japanese authorities are staring at 162.403. If dollar-yen ticks back toward 162.8395, and the Bank of Japan drops a single phrase about vigilance, that entire negative 97,092 contract book gets liquidated instantly. The liquidity vacuum CIPHER talked about becomes a waterfall. That is the risk. It's not a prediction of direction. It's a calculation of probability. The odds of a squeeze increase every time the price touches that 5-day high.
So we have a synthesized view. Pulse establishes that macro policy is conflicted, hawkish ECB, sticky US inflation but softening growth, which creates the fearful environment. Grid shows that technical structures are exhausted at key highs, 162.8395 in yen, 4,116 in gold, with no clear breakout momentum. CIPHER confirms that the yen short is dangerously crowded, creating a mechanical risk of a squeeze, while RC shows distribution signals. SPECTER warns that the low VIX is masking this fragility, and a breakout above 20.72 could accelerate the unwind.
What is the takeaway for the trader tonight?
The takeaway is that we are in a high-tension consolidation. The fearful regime is real, but it's not translating into a trending market yet. It's a standoff. The dollar-yen level at 162.403 is the epicenter. It is sandwiched between extreme short positioning and technical resistance. Do not chase the breakout at 162.8395. The risk-reward is skewed toward a rejection or a violent mean reversion, if that level is challenged by the Bank of Japan or by the COT data forcing an unwind. Similarly in gold, 4,072 is solid support, but chasing 4,116 is risky given the hesitation. Stay defensive. Wait for the VIX to decide whether the calm is about to break.
To summarize, we are tracking a fearful 14 over 100 sentiment index, with gold holding near 4,072.5 and dollar-yen consolidating at 162.403 amidst extreme COT shorting. The key watch is the dollar-yen 162.8395 resistance and the VIX range. Watch for a break above 20.72. Tomorrow, keep an eye on Asian session reactions to the UBS oil forecast and any Bank of Japan commentary. This is ShadowQuant Forex edition. Thank you for listening. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Forex edition. Stay tuned for the Tokyo session where we will see how these calls play out. Until then, trade safe.